Good afternoon, everyone. This is Henry, and as we get into tonight's free video, I'm picking up with the setup that I've been covering with you in previous videos through this venue. So if you've been following it, it's nice to see the resolution of it come through, albeit it did require earnings. But you'll remember here in Qualcomm that we were going all the way back and actually started the analysis with an annual chart. Right, going back into the .com bubble, we can see the surge up into the centennial level, just about to the tick. You sell off from there and stay below 100 for a couple of decades, and then as you surge above it, this is the pullback to the breakout, and we look at that off of that, very large perspective, and then that gives color to what you see, on the weekly, on the 3-day, and then where I was really focused on it with you, more so here on the daily. So on these daily charts, I'm looking for spots where I can take daily squeezes into these primary Voodoo lines, thinking that the fire line would be the most magnetic target. Now they kind of test that idea right down here into this demand zone before the report comes out. But then you have this report, right, which earnings can always be a little bit tricky, and there's no guarantee that these patterns will play out, but you see the potential that they have. Okay, now that we've revisited that one, we can come back over and look at Disney and see a situation that I believe is really quite similar. Now, if we go all the way back to we can pause here at the quarterly chart. This to me strikes me as a little different just because the breakout and the pullback has formed in a different way. But you can see the wick that was made back here in 2020. You can see this wick back here in 2014. Essentially it is 80, and it's the question of, will 80 continue to be support? Well, when I look at this, I see a very similar situation. Now, we don't have the same type of squeeze setting up here that we did in Qualcomm, but you have that same kind of relationship where I believe the fire line overhead at 91 could be magnetic. If price is magnetically drawn into it, that's where you have to consider it for resistance. So if these are ideas that you're wanting to get behind, and maybe you're wanting to put a little bit of risk on in a bullish way, I'm going to show you a couple of strategies here that I enjoy thinking about. Now, again, I want to point out that around earnings, these ideas are binary and they could go to zero very quickly. But if we think about 91 as being that overhead Voodoo area, we could construct a couple different butterflies, and those may still be decent ideas. But I think a lot about something like the $88 call. Say maybe Disney's down a little bit before then, and you can buy the $88 call for $1. Well, it's a generally pretty low debit. And if you do go to 91, you have the potential of tripling that $1 investment. Okay, so we'll keep this side pretty simple and just look at a debit that gives us that upside exposure. But then I like to see, where can I do my unbalanced butterfly on the put side to help offset the debit of this side? So let's just say that we do buy one of these, and we're going to do it at $1. Well, now we're on a mission again to try to offset that in a high probability way. You could always just sell the put, right? You sell the $80 put. That's going to be pretty close to getting that strategy to work, but that's going to imply a lot of risk, right? Disney down at 70, that's not going to be a very fun morning. So what we do instead of that is look at a strategy like the unbalanced butterfly. $3 wide, when that body is going for about $1, can be a good default. Get the trade to still go for a credit. Now, let's just say we do this at a dime. I'm not going to do 10 of them to totally offset the debit of the long call, but if we do a couple of them, let's say we do it 3 by 9 by 6, which maintains the ratio that we started with. Well, now you've got a situation that the risk profile kind of creates a unique spot for you, right? Because if the stock were to drop down into 80, that's where you'll actually do quite well, right? Because at that point, the 83 put will have $3 of intrinsic value. Now again, if Disney goes to zero, we want to recognize that these spreads as they sit would have about $1,000 of risk. But what I'm trying to do is see Disney up here into 91, 92, but saying that if it falls back down, it kind of creates an interesting hedge through that 1x3x2 strategy. So, like I said, I know there's a lot there. I hope you found some piece of it that is helpful for you. We'll see if it has any merit after Disney reports earnings, but I wanted to show you that Qualcomm chart. I wanted to show you the relationship in Disney, and we'll take an update on that once we get some numbers. So, y'all have a great rest of your night and good trading. I hope to see you in the next free video. Hey traders, this is Henry with simplertrading.com. I wanted to thank you for watching today's video. I hope you found it helpful. And if so, be sure to click the like and subscribe buttons down below. If you would like to also see me putting these ideas into action and trading my own account live in front of you, be sure to sign up at simplertrading.com, and I hope to see you in the chat room sometime soon.